All right, I want to welcome everyone to today's lesson where we're going to talk about the art of catching the falling knife and counter trend trading. And I know a lot of you are like, I've been told not to do it. Don't do it because every trading book 101 has said, you've heard these stock market sayings, the trend is my friend. Don't catch that falling knife, right? The market can remain irrational longer than you can remain solvent. You've heard all of these sayings. And to an extent, that is true. But what I want to discuss is a strategy that we've used for so long. And like I said, I'm surprised that so many more traders are not using this because there's so many people out there now just still trading with the old flag breakout, following the moving averages. And don't get me wrong, people can make that work. But when you're using that type of technical analysis, you are following the herd. And if you haven't figured it out by now, most traders lose. So if you follow that herd, there's a good chance that you are going to follow them right into that losing section, and that's not where you want to be, right? So there are some differences. Like when I don't like to use the word counter trend trading to define what we do because it's sort of like a counter panic or a counter euphoria because it's not what I would necessarily call a trend. And let me give you some examples. I'm going to show you a couple of trades that we had today because today was the kind of day where I've done a lot of parabolic videos. I'll try to post up some links where I've shown how my strategy works, and I've shorted a lot of stocks, and I'm sure I'm known mostly for doing that. But I also do a lot of panic buying when the opportunity presents itself. Now, in a bull market like we are in right now, you don't often see these types of opportunities, but today we seem to have a plethora of them, so I thought I would share how this strategy works, how we use it both as the short and and to the long side, and what you're really looking for. So the first, let's talk about debunking some of these myths where the trend is your friend. Now again, there's some truth to that. But what we're talking about, and the reason I said I don't like to call it counter trend trading is because what we're looking at is really not a trend. So for example, I've got AAOI up here, which was a very good trade today. And what you're looking at here is something in AAOI that you have not seen in quite some time. So first of all, we'll go to the bottom chart, which is the daily. So what you have is a daily chart that's obviously extremely bullish. And any stock that is extremely bullish, in this case, it has made a massive percent run up, even in a short period of time, is going to achieve what we call cult status. You've seen stuff like that with ACIA, with NVIDIA in the past. And what I say you haven't seen is you've never seen a day start out with solid red selling. Most of the days had maybe a couple of reds, maybe some small pulls, but nothing of this size. Even though it's not really that big in relevance to the chart, it's still something that most people who actively trade AOI had not seen. So you see how, let's say, thick this selling is. Now, to me, this is not what I call a trend. Something like a trend would be a little bit more gradient of selling or buying. For example, if you take a look at this auto zone today where you gap down on earnings and then you see it never really breaks out during the day, and then you get this late day sell-off. Now, what a lot of traders do is when they're dip buying, they're just dip buying because they look at the stock and they say, it's down so much, somebody must want to buy it. Same thing with the short. Stock goes up so much, it's up so much, so many days, somebody is bound to sell. Well, that's not always the case. The trendier the stock, and what I mean by trendy is the more gradient that move, the more sustainable. We've talked about that with longs when you look back at Teslas and you look at the Googles now. They got that long gradient. So this auto zone has a gradient sell. These will always be the most difficult. To me, this is what I consider trading against the trend. This would be, going against what a lot of those books had said and a lot of those teachings is this is not where you want to be. This is not what I'm talking about when I say counter trend trading. That's why I don't like to necessarily refer to it. In the look of AAOI, what you have here, to me, this is panic. And let me explain to you what the difference is, because it's not always about technical analysis. A lot of your market, most of your market money will come from common sense. So what I want to kind of do is go back, and I want to give you the common sense viewpoint of what's happening in real time and how I'm walking the traders through the trade room of what I'm thinking about this trade. If we go back, I'm going to just minimize this just for a second. Obviously, this stock has been in a run-up, and I have posted a few things about this stock being a great breakout on this flag breakout of 67.45, which I thought was good. But you look at the day before, which was Monday, this thing had run up about $7 and never really pulled back the whole day. That would be all this action right over here, $7. Now that's a pretty big, and when you look at the daily candle, that's a pretty big candle. It's a sizable candle that the stock has not really seen until you kind of go back here, right? And look what happened after that. But the point is, that was a pretty big move. Now what this is going to do is, as this stock is moving up, you're going to have a lot of bag holders created in a move like this, because it's going to go back to that first initial emotion that most people suffer from in trading, which is fear of missing out. You got the people that got in here at the right time, which was the $67 breakout. Then you got people that were thinking about getting into the $67 breakout and did not. And then they keep watching it, waiting for a pullback, and they're not getting it. They get frustrated and buy. Or you get the people that just are desperate, that they feel they're going to miss out on the opportunity because they thought at 67 it was overbought, or 68. And then finally they're like, hey, it's never going to come down. So my point is by the time this thing closes, it closes on high, and this gray area is post-market, by the way, and it stays that way. So it closes right up there at high a day, never pulled back. And everybody holds that overnight. So you got to think, all of these traders piling in the last 1 hour between the prices of, say, 70. I'll give them some leeway. $70 and 71 bucks. Right? So yeah, somewhere in that neighborhood. So you got all these people that are buying there as their initial entry. Any sight of red in the morning is going to shake those people out, because even the most undereducated traders are going to know that they chase this move. You're going to know that a stock that goes up 15% in a day, is usually not justified, unless it's a penny stock or something like that. It's different, but a stock of this size. So my point is, all you need is a little bit of red to shake people out. So what you get here is a really big pullback. Now, there's going to be a lot of people who look at this first pullback and they're going to wait. You're going to have the first people, they're going to have the itchy fingers and go, look, I chased and I'm getting out on this first bar. That's why it's so thick and it's so red, and they realize they got hooked and they got out. Then you're going to have that percentage of what let's say bag holder, for lack of a better term, hopeful, trying to wait for it. Well, let's see if it turns around. Let me wait just a little bit longer. Not criticizing. We've all done that before. And of course, what happens is it doesn't do that. And it just keeps digging in and digging in and digging in. And everybody back here who has bought in the last couple of hours the previous day, suddenly, maybe some of them were sitting on a couple of dollars worth of gains, and in a snap of the finger, they're all underwater, or some are becoming very close to being underwater, and they get out of the trade. That's what causes a lot of this panic. So you can see the difference of the first chart I showed you with the gradient, and then you see this really solid flush move. Now the thing is, with an AAOI, when you've got a very bullish stock like this, it's automatically going to, like I said, I use the word cult status, and usually a cult status, it's not 100% guaranteed, but they are going to find some bouncing zones. So one of the things when we're talking about catching a falling knife, it's just not looking at a stock and just saying it's down a lot, I'm buying it. It's flushing, I'm buying it. What I like to do is I look at a few things. One is the speed of this move, which I've talked about in parabolics, is how fast this move happens, how thick these candles are, and the size of the volume that you have. So you see that you have this to the downside. The next thing that I want to look at is the basic of all technical analysis patterns to me, which is support and resistance. Now, I just don't necessarily want to buy a stock because it's going down. I want to look for possible pivot areas, and then if the stock makes it to those areas, I want to look at it a little closer and judge the volume of that stock at that level. Now that'll give me some secrets to maybe where it might bounce. So the easiest thing to do, I'll make this just a little smaller, we're going to just go back to the previous day, and we're going to pick a couple of pivots from that previous day. So here is one indicated by these lines, just this little pivot right here. And again, when you're doing this technical analysis stuff, you don't have to be spot perfect. Please don't do that or try to nickel and dime it. you just need reference points. Again, technical analysis is not the end all to be all. It just helps you make a decision, and that's what we need as people, is to help me make a decision so I can just do something besides sit there. And then I'm going to go back and I'm going to look at this little area right here, which is kind of close. And then I'm going to go back and I'm going to look at this area. And then I'll go all the way back down into the gap and I'll look at this area. Again, you don't have to be perfect. You can see some of the lines are crooked, but it gives me those areas. Another secret is the market loves whole numbers. The reason market loves whole numbers is most people say, I'll buy it when it gets to 50. And if they put a stop loss, where do people put stop losses? Where does the herd put their stop losses? They put their stop losses on even numbers. So markets seem to migrate into those. So each one of these, if it's a couple pennies, I always go to the whole number. So I'll open this back up. Let's take a bigger look here at it. And we've got this price right here, which is, say, 69.70s. We've got this one here, which is about 68.80s, and this bottom one, which is roughly 67 bucks. We'll say 67 bucks. So as this thing is becoming red, already as the trader, I'm looking that far ahead. Even if the stock is at 70, I'm looking, hey, if it gets down to 66, this would be a killer bounce, or 67. This would be a monster bounce. Now you can see the first candle comes into, this is a 5-minute candle, by the way. It comes into that area, and you can see it's got a little wick on it and it bounces. Now a lot of traders, it's amazing, a lot of traders look at it and go, I wonder why that stock bounced. Or they're buying it and they're not really thinking about where you at. So you can see you got a little bit of a bounce here. Now it's not much, but it's a bounce. And when you're really looking at this and you're going back and you're doing your chart work, you can see that it's not such a secret that it bounced there. There was a level and they were trying to hold that, but it just wasn't going to happen. And you could tell that by the lack of buying volume and the lack of authority that it would bounce off there. Then it just kind of rotates here and starts to bounce at that next level. And then finally it really flushes out. You can see it finally shook out the first series of those dip buyers, encompassed with those people who were still bag holding from the day before. And that's where you get your really big bounce. And it's confirmed by the massive size of this wick. For those that are not up to date on technical analysis, a wick is a very good possible trend change in a stock. But the real key here for me, and one of the keys about doing counter trend trading, for a lack of a better term yet again, I'll have to come up with one better to use, is the secret thing that we like to call range. Range. It's all about range. I want you to remember that. And I'm saying it over and over again so you'll write it down. It's range. Now, range to me is defined by how much does this stock normally move during 1 day period of time. Now, when you look back here, okay, let's say the beta or whatever you want to call on this stock, you've got some pretty big candles. So this stock is usually a good $3 mover. You're going to get a $3 move most days. Most days, you're going to see a good $3 move out of this stock, up or down. Most lately, it's definitely been up. Now, what this means to you overall as a trader, maybe jumping topic here a little bit, or just using the common sense that we talked about, is that if the stock is up $6 on the day, you buying a breakout at $6 is already a challenging thing, because it's already 2 times outside of the range, if that makes sense to everyone. $3 normal, $6 is the price, it's up. Now, if the stock has earnings or something like that, that kind of gives you a different wild card. That's something that's a little bit separate. Earnings is one of those things that can really get a company to hold a 10% move or a 15% move. But for the most part, many of the news items, the chatters and all that stuff, it's just not enough to sustain it. So when we're looking at this stock, you got an immediate drop out of this thing from $71 all the way down to about the 67. So you've got well outside your, not well outside, but you've got outside your $3. And not only that, you've got a move that you haven't seen. So this turns out to be a great opportunity, and the further that it gets down into these levels, the better that opportunity becomes. Now, one of the other keys about doing this is not just the range, but the next step in this is, in order for you to succeed at something like this for the long term, you've got to trade lighter than you think, and I mean by position size. Where a trader may use a stop loss as a means of controlling risk. So let's say you're going to trade a stock and use a 10-cent stop, and you say I only want to lose $100. Well, then you can trade 1,000 shares. You know how many shares you can trade based on the amount of risk you're willing to take. One of the mistakes people make is they trade their normal sizes when trading, shorting parabolics, or trying to dip buy these stocks. And we've seen some mini surprises. Sometimes these stocks will go an extra $1, $2 against you. And if you're heavily loaded in that position, you're going to have trouble. Because one of the mistakes that we make is we feel that through some sort of technical analysis, we can top tick or bottom tick something. And I can tell you, after 17 years of trading like this, it's absolutely impossible. I never go into any of these trades thinking that I can bottom tick or top tick them. I always go in thinking I'm probably early, but I got to get a feel for it. So what I like to do is use either 1/4 or 1/2 of your normal starting size. So let's say 1,000 is your starting size. You could start out with 250 or 500 and then leave that extra 750 or 500 shares in the bag to add when you get a better feel for deeper levels of support. Now in this case, like I mentioned with AAO, I would not have done it at $1 down. That's not enough. That's not enough of a dip for me to buy. That's not enough panic. I don't consider that panic. $1.50, $2, not quite enough. But once it got there a little bit deeper, I became very interested. And this was one of the stocks that I had to add into it. So I get into it around the 68s, flushes down a little bit more once I see the wick get pulled back up. Then I go ahead and add to the position. Now, I'm not looking for a stock like this to go green. But what I am looking for is this. As I said in the beginning, common sense is a very big part of what you do as a trader. Common sense. Now, I just want you to tell me, even the biggest parabolic, the biggest mover you've ever seen in your life, think of that stock, or the biggest sell-off you've ever seen in your life, was there all green bars the entire day from start to finish? There was never a red ever in there, right? Or to the other side, there was all reds. There was never a single green. You've never seen a stock like that, right? So when you're looking at all these reds, you know it's not going to continue. It would be the first time ever in history that there's not at least one green in here, one bounce attempt. So even the trashiest, brokest, bankrupt, cruddiest dirtbag stocks will at least try to throw in a bounce. Somebody's always going to try to bounce it. But the key with this lesson is understanding a couple of these components. To me, one of those is the range that we talked about, being outside of range. The second is looking at near term, in this case, support, if you're shorting, resistances, if you have it. Look at those numbers and judge that stock when it gets to those numbers on the interest of, in this case, the interest of buyers in that area, or if you're going the other way, a short, the interest of sellers in that area. And the final piece of that puzzle is light. Because I did a whiteboard video, again, if I can remember these links, I'll put it on there. If not, just browse on the website, it's going to be on there, about how position size is what a lot of trading is about, that you can manage any risk. Because even if you went in here with 20 shares, the thing could go down $5 on you. You're not going to grenade your account. That might not be the smartest way to trade stocks. It might not be the right way to do it, but you won't be one of the statistics that blow up. So I think you know what I'm talking about here. So those are the three most important elements of you. So again, it's not just catching a falling knife. It's looking for these levels, seeing that range, and going in with smaller positions. That's going to allow you to make success out of the trade. Now you also see there's a couple other ones because they were all counter trend trades. So I'll go with like this TTWO. This was one at the beginning, which was the same thing in reverse, was that, earnings plays, you always have people say, don't short earnings play. Don't short an earnings play. Don't do it. Again, technical analysis books 101. No, there are sometimes, euphoria works just like panic. There will always be, and this is the reason why that counter strategy works so well, is because there's always people trading on emotion. You're never going to run out of that. And this is what this does. And it doesn't matter whether you think what your feelings are about the company. It's all about price. That's why we use technical analysis. But you got a big gap, a good run up. This is a nice, I would never have shorted this. I would never have shorted any of these moves in this pre-market. It never looked good. But as soon as the market opened and this thing stretched right away, I knew that was people chasing. I knew what that was. I knew who was on the side of that trade because all the people down here are going to sell. All the smart traders are at least going to take some money. This is nothing. Nobody would want to buy this up here. No long-term educated trader would. And this turned out to be a pretty good short. Same way, looking for those good pivot levels, starting them with a small size and calculating the range, and you get a nice pullback. Now, sometimes these things will go back up over high a day. Sometimes they'll go back under low a day. But for that period of time, they make great trading. And of course, Momo was another one. Those who are actively trading, Momo is also in a very, very strong uptrend here. Very strong uptrend. Same thing, almost looks identical to AAOI, where you get this really strong open morning flush on a very, very strong stock. And, you know, we catch this nice bounce. Now, as I said, like AAOI managed to hold itself. This actually went a lot lower. But that's not the point. The point is, for that moment in time that you're trying to capture your alpha, this is what we're all trying to do, is get in at the right times, the best time that we can. And we're never going to be perfect, but we need to do everything that we can in our power to eliminate some of the worst case scenarios. So you see this looks very much the same. And of course, I got a little one here on Cena. Same thing here. Had a little tougher time, obviously. You can see with the P&L with Cena, because it didn't quite give me that last flush. Once it got down to here, it was kind of starting to put a trend in. So it took a little bit of time. But again, the position size, allowed me to stay in that trade. So as I review this little lesson, what you're always looking for is the range of that stock. So it doesn't matter whether you're going to dip buy or you want to short pairs. Take a look at that. And I want to say that this applies to bigger board stocks. If you're trading penny stocks or dry ships and stuff like that, you know, that's just sometimes that stuff, you know, technical analysis just does not apply to certain situations. But in most cases with these stocks, you're looking at that range. Anytime a stock gets outside of that range, it makes it difficult for your normal technical analysis parameters to work. So if you're a flag breakout buyer, if the stock only has a $2 range and it's up $4, you're going to have a hard time overall getting a good breakout. You're asking a lot for that stock to continue. So you want to look for that range. That's number one. The second thing, as we said, you're looking for support, resistances, bouncing areas, whole numbers. It's not a guess. It's not down because it's down a percentage amount. You're looking for possible areas. And you're not just saying, hey, it gets there, I'm going to do it. You're just looking at these areas and you're saying, I want to see what the stock does when it gets there. Because maybe this first support isn't very good. It's terrible. They don't want it there. They want to run down to the next level. And then you try to judge that through volume, and it's going to take some time, of course, in repetition. And the last, which goes through all of your trading, is position sizes. Position sizes cures just about every single emotional problem a trader will have. Can be fixed through proper position sizing. You get too heavy, you know exactly what I'm talking about. You get too heavy, you get too aggressive, you get too greedy, you suffer, you pay the price, and you lose, and you get nervous, and you get anxiety, and you end up making a judgment call that's usually wrong, and it's based out of fear and emotion rather than what's actually happening. Position size. Always give yourself the flexibility to work the trade. So I hope this helped you. As I always say with these videos, if you want to see this stuff in real time, visit thelincolnlist.com, take a free trial to our live trade room. You get to see all these trades pan out in real time. You get to hear me talk you through these. So not only are you trying to learn a strategy, but you're understanding the real components and the fundamentals behind what makes these trades work. So thank you for watching this video. Until the next one, take care of yourself. I'll talk to you soon.